All right, we are on chapter 18, so let's get started here. This is worthwhile to look at just to see what you're going to get through in this chapter. So this right here, the diluted earnings per share, this is the tough one. Although some of these other things, this is not an easy chapter, so we've got that to look forward to. All right, so the first thing we're going to talk about is conversion of convertible securities. I don't have all of these things on your handout, so I've got to kind of flip through theirs and kind of see what we're doing here. But basically, some of these things, the question is, are they liabilities or are they equities? So stock options, a lot of times companies give you stock options as part of your compensation. So for instance, if a company gave you the option to buy some shares of stock for $100 per share, but the current selling price was $95 per share, or the current purchase price was $95 per share, you wouldn't be too thrilled. But if they gave you the next 5 years to exercise those options, the theory of the idea is that you would work hard for the company so the share price would go up, and then in 5 years you could exercise the option to buy them for $100 when the share price was up to $140. So the stock options, convertible securities, this is where they go from, you've got debt that's you can convert into stock, and then preferred stock. I don't really know why they have this question, but anyway, we're going to do those as equity, and you're going to find out, pretty much. You're going to do them like you think you do. The debt you treat as debt, the equity you treat as equity. All right, so sometimes a convertible bond, they sell it so that it can be converted into stock at the holder's options. So basically 2 reasons is that they want to raise capital, but they don't want to give up shares of stock right away. So they give the owner the option to do it. And then sometimes they can pay a lower rate of interest, but it maintains our ownership for a while. At that, notice that how we're going to do it is different than IFRS or international, which requires you to record the debt and liability components separately. But basically what we're going to do is we're going to record it straight debt. And basically what's going to happen in this chapter, if we can separate out the value of the two, then we do, and if they are detachable. So for instance, you might later on buy a bond with a detachable stock warrant. Well, that's different because you can take it off and sell it separately. But if this is part of one, piece of paper, if you will, if you can't separate off the conversion feature, you can't tear it off. And basically you can't if you're going to convert it into it. You either have debt or equity. You don't have debt and equity. But anyway, if you can't separate it, we're going to value it as 1. If you can separate it out, we're going to value it as 2. So remember that. All right, so here's an illustration. Notice that they say 4 million, 7% bonds. They're issuing at 95. If they didn't have the conversion feature, they would have sold for 95. I meant 99. So we just simply ignore the fact that it's convertible and issuing them at 99. So 4 million times 99 is your cash, your bonds payable is the 4 million. Okay. This one, what method is used when converting debt and what does it mean? This method is called the book value method. So that's that answer. So basically, what you do, the book value method means the value of the stock that you got gets the same book value as the debt had. So whatever the debt is on my books for, that's now what the stock is on my books for. Thus, it's called the book value method. The alternative would be a fair value method where I would value up the debt to its fair market value and then convert it. We don't do that. So notice, since I use the book value method, I just flipped the debt for the stock. I have no gain or loss upon the conversion. So we're going to go into this one here. So Moore Company has outstanding 2,000, 1,000 bonds. So actually up here, right, the value of the stock is 2 million, right up here. Sorry, bonds, 2 million. Each convertible into 50 shares of $10 par common stock. The bonds are convertible on December 31st when the unamortized discount is $30,000 and the market price of the stock is $21 per share. Okay, so first of all, since it's the book value method, cross this out. I could care less that it's $21 per share. So basically, what I need to do is figure out what the bonds are on my books for. So I have $1,000 bonds. Okay, so my bonds payable, I wrote this up here, is on 2 million, and they have a discount of 30,000. So remember, a discount is taking the value of the bonds down, so it's going to go the opposite way. A premium would be the same way. So the first thing I need to do is these two entries right there. Get the bonds payable off my books for 2 million, get the discount off my books for 30,000. So this is getting it off my books. Now all I'm going to do is put the stock on my books for what the bonds were on my books for. So notice this is 1,970,000 net. So I'm going to credit the common stock for each bond is convertible. Each convertible into 50 shares. So I have 2,000 shares, 2,000 bonds times 50 shares each. So 2,000 times 50. So if you want to write 2,000 bonds times 50 shares times $10 is $1 million, and the rest goes to additional paid-in capital. That's the book value method. So again, get the bonds off your books. They have two accounts, the bonds, the discount. Get the common stock on your books. You can only credit common stock for par. The rest goes to additional paid-in capital. How many shares? Each bond got 50 shares, so 2,000 times 50. Next one. What happens if you have to pay the bondholders a little sweetener, they call it, to do something? So anyway, so sweeten the pot here. So if I want them to convert quickly, I sometimes pay a little extra for it. So notice that, please remember this, and maybe you should write it out here, kind of right here, over here. A sweetener is an expense. So in this particular problem, I have the same problem. So look here. I get the bonds payable off my books, get the discount off my books. I record the stock and the additional paid-in capital. This entry is the same. But what do I do with that $70,000? It's an expense, so debt conversion expense and cash. So you can just write same entry plus you expense the sweetener. So remember that, expense the sweetener. Okay. They have anything on here about retiring debt. When you retire debt, you simply, let me go back a slide, get the bond off your books. So you're going to have this entry because I got to get the bond off my books. Okay, I'm retiring it, so I'm paying it off. So I credit cash. So if I didn't pay cash of equal to that, I have a gain or loss. If I have a credit to balance, I have a gain. If I need a debit to balance, it's a loss. So in this case, cross through those things, you wouldn't have that. I would get the cash I paid for it, and then I would have a gain or loss plug. So it's not really that difficult. Okay, so let me pause this a second, figure out. Okay, convertible preferred stock is basically you can convert your preferred stock into common stock. So I think you could have guessed that convertible preferred stock is part of stockholders' equity, because where else would you put it? Preferred stock and common stock are both stock. So just like the bonds, I just take it out of preferred stock and put it into common stock. The only time I'll ever have an issue kind of with this if there's a difference in the par value between the two. But honestly, you get it off your books for what it's on your books for, and then you pretend you issued the common stock. It's like that. So let's go in here. This one's this one, the Gall Inc. So Gall Inc. issued 2,000 shares of $10 par common stock. So sometimes it's easier to write it out. So I've got common stock up here. So please write, I guess let's sort it out here. We've got common stock, 2,000 shares, $10 par. Upon conversion of 1,000 shares of $50 par value preferred stock. So in other words, they issued these because you converted the preferred into common. So it's kind of, I would have written it the other way around, but would have said we had preferred stock that we converted into common, but notice they issued these upon conversion. So first thing is I get the preferred stock off my books. Notice the preferred stock was originally issued at $60 per share, so think about the original entry. So I would have debited cash for $60 times 1,000 shares, credited preferred stock for 1,000 times 50, and that other 10 goes into additional paid-in capital. So the issue entry again, debit cash, credit preferred stock, credit additional paid-in capital. So now I need to get that preferred stock entry off my books. So now I debit preferred stock. So this one, make sure you know, this is getting it off your books. I get this off my books. So the $50,000 and the extra $10 times 1,000 is in additional paid-in capital. So I get it off my books. Now put the common stock on my books. So for the same $60,000. So 2,000 times 10, and then the rest goes to additional paid-in capital common. So all I'm doing is flipping it out of preferred into common. Total amount $60,000. Why isn't this 50 and 10,000? Well, it's simply because the par value is different. So this one you might want to put preferred stock in parentheses 1,000 at $50. Okay, so the only reason these two entries don't match is the par value is 50 up here and 10 down there. Okay. All right, that wasn't so hard, was it? Now we're going to talk about stock warrants and stock warrants issued with other securities. Okay? So the other things might not quite be so easy, but that wasn't so hard. Now was it? All right, so why do you have warrants? Warrants are basically certificates entitling the holder to acquire shares of stock at a certain price within a certain period. Okay? So remember before when I said if the conversion feature could not be detached, then you just recorded it as if it were one. So in other words, the bonds that were issued that were convertible into common stock, I kind of ignored the fact they were convertible and I just recorded them for the bonds. The preferred stock that was convertible into common stock, when I issue the preferred stock, I ignore the conversion feature and just record them like normal preferred stock. However, this one, warrants are certificates entitling the holder to acquire shares of stock at a certain price. Okay? These are extra. These are separate from the item itself. So these warrants can be detached, and that's important. So why do we have these? To make the security more attractive. Existing stockholders have the preemptive right to purchase the common stock first, and also issue it for a form of compensation. So you give them these stock warrants. Okay, some other things about stock warrants is they're basically you can buy common stock at a fixed price. They generally have a life of 5-10 years. So think about it. If your employer gave you a warrant to buy stock within the next 5 or 10 years, and you can get the price to go up, you might have come out ahead. You do, since these are separate, since you can tear them off, they're separate from the bond, etc. You're not converting the bond into the stock. You're getting additional stock and still having your bond. So we allocate the proceeds. And there are two ways to do it. We've done these before, proportional and incremental. And we do the allocation based on fair market value. The proportional is just basically if the fair market value is 1/3 and 2/3, then I allocate them 1/3 and 2/3. The incremental is I give the value to the security I can identify and the rest goes to the other ones. We're going to do a couple of these. So under the proportional method, I determine the value of the bonds and the value of the warrants. And so again, if this is 1,000 and that's 100, I give 10 times the value to the bonds as I do the warrants. So that's proportional. So let's go through one. I don't know that you need to write out this entire thing. I just generally do ratios. But We have Margol Corporation issued 2,000 $1,000 bonds at 101. So that means 2,000 times 1,000. Okay, and then that's 2 million at 101. Okay, so take 2 million times 1.01, 101%. Each bond was issued with one detachable stock warrant. After issuance, the bonds were selling at 98, and the warrant had a market value of 40. So anyway, since I need to allocate my purchase price to both, I need a fair market value of both. Okay, so look, here's the warrants, 40 bucks, so 2,000 warrants. Read it carefully. Each bond was issued with one warrant, so I have 4,000 warrants times 40%. I have my bonds. This is with the warrants together. This is without, so 98. So 2,000 times 1,000 times 98%. So I have 1,960,000. You can do 96, you can get the percentage, or you can just do 1960 divided by 2040 times the 2020. Okay, so that's 101. 2,000 times 1,000 times 101 is the issue price. So put that up there, issue price. 2,020,000, okay? And we have 2,000 times 1,000 times 98 is the value of the bonds. 2,000 times 40 is the value of the warrants. So 2020 times 1960 over 2040 is 1,900,000, whatever that number is. And then the value of the warrants is 80 2040ths. You can do 4% if you want, or just use the fraction to get 7912. Okay? So basically what's going to happen then is I need to put my bonds on my books for 1940 and my warrants on my books here. However, remember, bonds payable can only be the face amount. So that's why I've got the discount here. So I need the bond face amount to be 2 million. Then I have the discount, so the net of the two is 59,216. So I might come back to this slide. Oh, I got it on here. So what I want you to do is I want you to circle this right here, these. Or better yet, why don't you just do it here. Whoops. Pause here. Okay, do this. Okay, those two together has to equal this 1,940,784. So write that out there. I'm not going to write it all out. Okay, so 1,940,784. Okay, the stock warrants has to be 79,216. So I credit paid in capital stock warrants, and I issued them for the 2020, which was the 2,000 times 1,000 times 101. Okay, so take it a step at a time. I got cash. The bonds payable have to be total for 1,940,780, which is including bonds payable of face, plus the discount, and the warrants go for that. Okay. All right. Okay, now let's go to this one. Assume each warrant, and we're right here. Assume each warrant can be exercised to buy one share of common stock, $5 par of Margolf Inc. for $30 a share. If they exercise all 2,000 warrants, they make the following entries. So notice I can do 2,000 for $30 a share, so 2,000 times 30 is cash. Okay? If I go back to the previous one, I have paid in capital stock warrants. I no longer have the warrants in there, so I need to get this off my books. So I get rid of the stock warrants, and basically I got cash and stock warrants in exchange for actual stock. So now I have my actual stock, 2,000 times $5 par, and the rest goes into additional paid in capital. So this right here is just a plug figure. So cash, compute 2,000 times 30, get the paid in capital off your books because I no longer have paid in capital stock warrants because my stock warrants are gone. I switched them out for the stock. And I put the stock on my books. 2,000 times 5, the rest goes to additional paid in capital. So don't make it really more difficult than it is. What did I get? I got cash and those stock warrants in exchange, and I gave out in return stock. Okay? Next one. Incremental method, I just basically give it to the security that I can determine the fair value, and the rest goes to the other ones. So I believe we have over here the McCarthy one. McCarthy issued $2,000, $1,000 bonds at 101, so we've still got our $2,020,000. Make sure you write these computations someplace. Hopefully you have some space in your margins on the paper. But write that out. So I got this, $2,020,000. Write it over there. Each bond was issued with one detachable stock warrant. After the issuance, the bonds were selling at market price of 98. The market price of the warrants cannot be determined. So this is fairly easy. I simply can only determine the $1,960,000, so I give that to the bonds and the rest goes to the warrants. Okay, so again, back to your journal entry. I got cash of $2,020,000. The bonds have to be for 1960, but I have two accounts. The bond itself, which is at face value, and then the discount, so I want that to be $1,960,000, and then I issue the warrant. So make this journal entry there. I have my cash, and then I have this. Those two net out to this thing right there, $1,960,000. So I have to do bonds payable for face, discount to get the net amount of their carrying value. I give the $60,000 to the warrants, and I have my cash. So start with the cash, $2,020,000 right there. I want to allocate $1,960,000 to the bonds, so I'm going to write that kind of out here. And then I'm going to look, and I credit bonds payable for the face. The rest goes to the discount, and then I issue my stock warrants. Okay. So kind of take a second to step back and look at the two methods there. Okay, so this is kind of saying just what I did, that the stock warrants are really two securities, so you have to report them separately. And if they're non-detachable, it's only one security, so you just record them all together. Okay, stock rights, rights to subscribe to additional shares, have the right, preemptive privilege. Usually the price is less than the current share price, and you really don't record anything except you make a memorandum entry. So this is the preemptive right. So we have the right to purchase it, so at a lower price. So there's no journal entry made because nobody bought anything. Stock compensation plans. Doesn't seem as hard as it looked, this chapter. Look, we're almost ready for number 5, but until we get to this one right there. That's the hard one. Okay, so we're going to talk about stock compensation plans. Got right here. Okay, again, I talked about this before, so I'm going to actually draw them here. So let's say as part of your bonus, your company gives you a stock option, the option to do it. Option to buy it for $100. Okay? The current market price is 95. Woohoo! You could buy it for 95, or you could buy it for 95, or you could exercise your option and buy it for 100. So you're not really thrilled. But notice this is usually given over an extended period of time. So let's say you have the option to buy it for 100 for 5 years. Okay, so now you're going to work really hard for the company, so this stock price actually goes up to $195. You really can't read my writing there, but that's $195. So now at the end of the 5 years, you're thrilled because you exercise your option to buy it for $100 and you come out ahead $95. So notice, it motivates employees. It helps retain people because I think if I work there, I can actually get my bonus based on this. It maximizes employees' after-tax benefits because we can exercise our option, we kind of get some compensation, and we can put off some taxing. And usually these are granted based on some pre-described criterion, so that's what they have that. I don't know that everybody completely agrees with that, but that's what the book says, so that's what we're going to go with it. Okay, so Notice that option grants, and all this one really basically says is because the gap has really kind of tightened restriction on options, that they're not as common as they used to be. Go through that. All right. So how do we value the measure of this compensation? So I just said, okay, I gave you the option to buy stock. So what's that worth today? And we said kind of, it's not worth anything if you can buy it for 100 and the market price is 95. But anyway, there is, but then we stick in that the idea that you can do it after 5 years. And so now the question is, what is the value of it? Okay, so what's important under here is this statement, fair value method. You need to know that. Stock options use the fair value method. And they use an acceptable options pricing model. So in finance, you may have heard of the Black-Scholes pricing model. We do not determine it in this class. You will be given it. So the fair value method and the amount will be given to you. We will not have to compute it. You can kind of read through those. Those are kind of important. So here's my question. Since it's compensation expense, I have to debit wages expense to simplify it, and wages payable. But how many periods do I use this compensation expense? Because I said I had 5 years to exercise it. So that's all a question in that. So how much is my compensation expense and how many periods do I allocate it over? So the compensation amount has to be given to you. Remember, it's the options pricing model, which is beyond the scope of this text. And the period that we're going to allocate it over is called the service period. So it's where the employee performs the service. So we've got to identify the value of the option and how many years we're going to spread it over. So this is this one. So in 2016, the stockholders of Cero Company approve a plan that grants the company's 5 executives options to purchase 2,000 shares of stock. So let's get that separated out there. So circle it or write it out to the side. We have 2,000 shares right here, 2,000 shares, $1 par value common stock. They grant the options on January 17. They may exercise the options at any time within the 10-year period. The options price per share is $60. Okay, so the option price per share is $60. Hopefully you're writing these out someplace here. And the market price of the share is $70. So that we need to know. Market option. Under the fair value method, the company computes total compensation. So remember, this is given. That expense is $220. So I've got $220 is my value of my expense. I just don't know how many years I'm going to allocate it over, etc. Okay, so let me clear that. Okay, so assume that the expected benefit is 2 years. Let me go back. So notice I have 10 years to exercise it, but I'm actually only going to spread it over 2 years is what I've said is the time I've earned it. So don't just go grab that 10 years. I have to be told. The benefit is 2 years. So I take my $222,000 and I spread it over 2 years, and that means I have compensation expense. So this is wages basically. I'm just not paying it out in cash. I'm paying it out in stock options. So compensation expense. This is given. The 2 years is given. They have 10 years to exercise it. That is just in there because, I guess, to mislead you a little bit, but notice the exercise time is not necessarily the time at which they earn it. Okay, so there's your journal entry. All right, so now this one, let's go down here. If they exercise 2,000 of the 10,000 options. So remember, I have $110,000. That's because it was given right there. But I have 2,000 shares that I have to purchase. Okay, and I have 5 executives. So 2,000 times 5 is 10,000, right? So I have 2,000 of the 10,000, so I have debit cash. Let's go back. If you'd written all this down, they have the option price to buy it for $60. So know the market price is $10 higher but I have the option to buy it for 60. So option price to buy is 60, market value is 70. Okay, so I'm going to buy it, 2,000 shares. I buy 2,000 shares for $60. So the company is getting this. I'm buying it as a employee. Okay, so let's go back up here to this one. Paid in capital stock options has 220,000 in it total. I can divide that by the 10,000 options and multiply it by 2,000, and so I get 44,000 out of it. And I have common stock. Notice, let's go back. It's $1 par. Okay, so basically I get the cash, get the stock, paid in capital stock options off my books. I have common stock for 2,000 shares times $1 par, and the rest goes to additional paid in capital. What if they fail to exercise the remaining options? Well, I have I got 44,000 off my books already, and the rest of them were not exercised, so I need to get it off my books. But look at this. Notice I'm taking it from paid in capital to paid in capital. So just identify the source. It's no longer stock options, it's expired stock options. Notice that the company does not adjust compensation expense upon expiration. However, if they forfeit them because they leave it during, let's say you had to stay there 5 years, etc., then you might adjust the estimate of compensation expense. Restricted stock notes. Restricted stock plans transfer shares of stock to employees subject to an agreement that the shares cannot be sold, transferred, or pledged until vesting occurs. And remember, vesting is you have to stay there long enough to keep it. So there's a time period on how long they have to stay to keep it. So it never becomes completely worthless, and it encourages people to stay there because they'll vest. Okay, so this one. I skipped this handout, so we're right here. On January 1st, they issues 1,000 shares of restricted stock to its CEO, Rail Stalker. Skidmore's stock has a value of $20 per share, so 1,000 times $20. Additional information is as follows. If your last name is Stalker, please don't name your kid something like Rail Stalker or Home Stalker or anything like that. Name them, just a normal name like Fred or something. But anyway, the service period is restricted to the 5 years. This has to be given. Okay, vesting occurs if they stay with the company for 5 years, and the par value of the stock is $1 per share. So on the grant date, what they do is they have common stock. So let's go back. Oops, I guess I could show over here. So I have 1,000 shares of $1 par. I have paid in capital, and I debit unearned compensation. It's not an asset. It is part of stockholders' equity. So why don't we just put unearned compensation dash stockholders' equity, okay? And if you think about this, basically it's kind of a wash here. So this is the grant date, and it's services yet to be performed, which is not an asset yet. So unearned compensation is going to turn into compensation. So then, when I get there, I take it out of unearned compensation and I put it into compensation expense. So record the journal entry when they record the compensation expense. Notice it's 5 years. So let's go back here. 20,000 divided by 5 years is 4,000 a year. So make sure you make that note there. So it's this 5 years. So maybe write it down here. 1,000 shares, fair market value of 20 is $20,000. So write that there. You write down here. $20,000 divided by 5 is $4,000 a year. Okay, assume that Stalker leaves on February 3rd, 2019 before any expense has been recognized. So I, in essence, have to kind of, where are they leaving? 2019, so 2017. So I have 2017, 2018, 2019, okay. Okay, so 2017, 2018 have been paid. It says before any expense has been recorded in 2019. So they have recorded 2 years of compensation expense. So they've made this entry for 2 years. So the first thing I need to do is undo that entry. Get rid of that. I've done this entry for 2 years. So I flip that entry for 2 years. Okay. Get my unearned compensation off my books, the remaining balance. Okay. And I get my stock off my books. So go back here. I, in essence, if I kind of do a little thing on this one, I have 8,000 that's been moved to compensation expense, and I have 12,000 sitting in unearned compensation. So I'm going to debit this, debit that to get it off my books, credit the remainder of that, and the 8,000 that's in compensation expense, I get rid of that. So let's go to that. So, whoops. So you can see that's what I've done here. Okay, so stock purchase plans and disclosure, you can kind of read through that. We'll talk about that at, well, I guess maybe I should talk about it now, but I'm kind of getting tired of this. Purchase stock at a discounted price for a short period of time. And notice it has to be what they call non-discriminatory. Non-discriminatory plans doesn't mean the same thing as discrimination in the sense that we usually think about discrimination. It basically means you can't discriminate and only give something to the highly compensated, so the executive, the C-suite, if you will. So notice that you have to have substantially all full-time employees participate on an equitable basis. So it has to be some sort of equitable basis. The discounted market is small, and the plan offers no substantive option features. So it's not a stock option plan, etc. So basically, this is just a discount. So since I'm an employee, if you've ever worked for a store and you get a 15% employee discount, okay, that's what this is, except it's on the stock. Just some other stock compensation plans, you just have to disclose it in the notes to the financial statements. And that is where I'm stopping. So we're going to start with earnings per share in the next one.